All right. So you're ready with your real estate investment deal. You're excited and you're not sure whether you should be working with a hard money lender or you should be working with a private money lender. Well, in this video, I'm going to break it down for you in both in terms of the differences between how hard money lender and private money lenders operate, and also most importantly, understand the financial implication. What does it cost to work with a hard money lender compared to a private money lender? If you haven't subscribed yet, hit the subscribe button and the bell so you can be notified every time I post a new video about raising private capital. My name is Amir Khan. I'm a real estate investor, mentor, and coach based in Dallas, Texas. I have over 25 years of experience both on the residential and commercial side. While I've worked with both hard money lenders and private money lenders, I have experience exclusively working with a lot of private money lenders, but I thought it would be a great idea to give you a clear understanding of what the main differences are when you're working with a hard money lender and a private money lender. So let's dig right in. So here's an overview, 11 areas that I'm going to talk about, which will give you a good overview about hard money lenders. Number one, hard money lenders are professionals. They're not amateurs, so you're dealing with professionals and they know what they're doing. Number two, hard money lenders can be individuals or they could be institutions, but they are not traditional financial institutions. Number three, they primarily are lending for short term. So it could be anywhere from 1 month to 6 months to 24 months, sometimes even longer. Now, hard money lenders primarily lend on the collateral in question. So they're looking at the property that you bring to them. They do look at your credit in some cases. If the property has enough loan to value ratio, they may or may not even require credit checks. Depends. Number five, they generally will charge higher interest rate and may require down payment. This all depends on the loan to value ratio. And number six, most hard money lenders will charge both interest rate and origination fee. Number seven, they can generally fund very quickly. That is one of the big benefits of hard money lenders. Number eight, they may or may not be licensed in the state, or the state that they operate in may not require a license. It depends on two things. It could be either the area that they specialize in, the kind of loans that they do, and of course the state that they operate in. For example, in California, they are required to have a broker's license regardless, whereas in Texas, if they're only doing commercial loans, which is non homeowners, like they're doing investor loans, they don't require any license. Number nine, hard money lenders may lend only in certain states. So before doing business with them, you need to check whether they lend in your area. Number 10, some hard money lenders can lend on they will only do business for a certain asset class. For example, they may only do multifamily compared to single family homes. And finally, hard money lenders, this is very important to understand, pool funds. And these funds may include their personal funds. It could be a debt fund that they manage. It could be funds from other individual investors. It could be bank credit lines, and it could be a pool of funds that they have gathered from their family and friends. So these are the 11 areas that gives you a good overview of hard money lenders. Before we go on, I have a small gift for you. It is my top 5 places to raise private money guide. It's a free PDF guide. The information is in the description. I've had success doing this. It's a very specific step-by-step instructional that is platform specific. So get the information in the description below. All right, so here I have again 11 points which will give you a very good overview about private money lenders. Number one, private money lenders are non-professional lenders. Very important for you to understand and really follow this point. Number two, private money lenders are always individuals and not institutions. That is a red flag if you're dealing with someone who's pretending to be a private money lender and is in fact an institution. Private money lenders can offer short-term, medium-term, and long-term loans. Number 4, because private money lenders are not professionals, depending on the type of asset and the specific real estate strategy that you're involved with, they may require some education from you who is a borrower. Number 5, private money lenders make their lending decision based on the value of the property, which is the collateral, borrower's experience and track record. And number 6, private money lenders are generally able to offer you reasonable interest rate as long as the interest rate you're offering is competitive and of course better than the alternatives available to the PML. Now, some PML may charge origination fee, but most don't. PMLs are, I say PML, I'm talking about private money lenders, are not licensed. Number 9, they can usually fund quickly as well because they have their own funds. And this is also important. Number 10, PMLs may only lend in certain asset classes. And in most cases, I found it is because of their past experience. In other words, they've had some good experience in a certain asset class and they're willing to lend on that, whereas they may not be so willing to do that in a new asset class. That's where the education comes in. And number 11, PMLs are generally going to use their own personal funds. This could be a savings account, a HELOC, some other kind of cash-based account, or a retirement account. So those are the 11 points to understand about private money lenders. So now in this next section, I'm going to give you a top 10 key areas where there are differences between private money lenders and hard money lenders. All right, so what you see on your screen are going to be each one of those. I'm going to go through, break it down for you. All right, so first I'm going to talk about the key area, then I'm going to talk about how does that apply to hard money lenders compared to private money lenders. Let's start with source of funds. As I've mentioned before, hard money lenders are institutions or organized lending companies, often with pooled funds from other investors, including their own, right? Whereas for private money lenders, it's pretty clear. It's an individual with personal funds. Next key area is the approval process. For hard money lenders, it's fast. It is collateral based, focused on the property, like I mentioned, the after repair value, and so on and so forth. So they pretty much have a standard criteria and procedure. For private money lenders, it's very flexible. This is very important. It's relationship built, driven, and they may consider both property and the borrower when they're making their lending decision. Next key area is loan terms. For hard money lenders, primarily, there's a term used in the industry is velocity of money. They're interested in making quick interest and income on loans. So that's the reason why they do short term, 6 to 24 months ideally, with a higher interest rate and fees, and they're quite inflexible on those. Whereas when you're dealing with private money lenders, they can be short term, they can be medium term and long term. They're more negotiable and oftentimes lower or very lower rate. Next key area is interest rate. Of course, hard money lenders, like I said, are professional and they're in business for doing this, so they are higher. Their interest rates are higher, reflecting risks and speed, often between 8 to 15%. Oftentimes it's even more than 15%. And then for private money lenders, it's variable, often lower than hard money, and depends on the relationship and risk that's involved in that particular deal. Next key area is documentation. For hard money lenders, it's minimal compared to banks. Of course, banks go into a lot more detail, but when you're dealing with private money lenders, it's a lot less. It's often based on trust and personal relationship. Then the next key area is type of deals. Now, hard money lenders, while they do different asset class and different strategies, a lot of their deals are fix and flips, bridge loans, time-sensitive deals, and they also look at deals that are often turned down by the banks. and they know that they are able to fund it. Whereas for private money lenders, it's relationship built deals, it's long term investments, and they're open to creative financing as well. The next key area is flexibility. Hard money lenders are, like I mentioned before, they have their own processes, they are going to be less flexible, and they will have standardized terms and criteria. For private money lenders, they are very flexible, terms can be customized to borrowers' needs. Next key area is regulation. Hard money lenders, like I mentioned before, in some states they are required to have licenses, or some form or the other they are regulated, whereas private money lenders are usually not licensed. Next key area is the emphasis. What are hard money lenders looking at? They're looking at two main things. They're looking at the property value, the collateral, and they're looking at your exit strategy. What do you have plans? What are you planning to do with the deal? Whereas private money lenders, they look at both property and borrower's financial strength plus trust. And the final key area is the relationship. This is very, very clear. This is very important to understand. For hard money lenders, it's very transactional. It's business-like. Whereas when you're dealing with private money lenders, it's personal, it's trust-based, and often an ongoing relationship. There you have it. 10 key areas that are distinct between hard money and private money lenders. Before I go to the next part, let me briefly tell you about what I have helped my students achieve through my coaching program, where I teach them advanced strategies, systems, and tools geared specifically towards raising private capital. And if you are interested, the details are going to be in the description below. Finally, I'm going to discuss the cost difference. What does it cost to work with a hard money lender compared to working with a private money lender? Now, I have to be honest with you, most of my lenders are private money lenders. While I do have experience working with hard money lenders in past, I wanted to do enough research and bring you enough information that should be as accurate as possible. However, still, if you're going to consider working with hard money lenders in your market, I highly suggest that you research the hard money lenders in your market specifically, so you can know the rates and the requirements that are specific to you. All right, so having said that, let's compare the cost of doing business between hard money lenders and private money lenders. So we are looking at 5 aspects. Number 1, interest rate. Very, very obvious. We all talk about it, but this is important to understand. Hard money lenders are going to be expensive. Typically, it's 8 to 15%, but it can be more costly, very, very easily. Private money lenders, on the other hand, are often lower than hard money and are negotiable. Aspect number 2, origination fees. Hard money lenders will always charge origination fees. There is no way you can get out of that. You can try to negotiate it, but that's how they make money. So they have higher upfront fees. It's often between 1 to 5% of the loan amount. And then in terms of private money lenders, it's negotiable and often not required. Next aspect is other fees. So I already said that hard money lenders will always have interest rate and origination fees. But guess what? There are other fees. All right, for hard money lenders, this may include appraisal fees, underwriting fees, and prepayment penalties. And for private money lenders, often there's less formal and there's no other fees required. Next aspect is the loan terms. Like I said before, hard money lenders are primarily short term. 6 to 24 months ideally. They'll go as short as 1 month, and it's interest only payments. Whereas when you're dealing with private money lenders, they can do medium term, they can do long term, and terms are always negotiable. And finally, down payment. Hard money lenders will require higher down payment because of the risk factor involved. They look for 20 to 30% based on the property value. For private money lender, again, it depends on your relationship. but often it is not required. So there you have it, top 5 aspects of cost of doing business between hard money lenders and private money lenders. So I hope this video has been helpful for you in understanding the main differences between hard money lenders and private money lenders. As you can see, hard money lenders are definitely valuable in certain circumstances, but private money lenders can be amazing to work with. That brings me to a point which I'm sure you must be wondering, well then why would people work with hard money lenders at all? Why doesn't everybody work with private money lenders? And here's the simple truth. There are tons and tons of hard money lenders available. Even if you have not a great deal, you can always find a hard money lender who will actually lend you funds. Their terms might be higher interest rate, more fees, but you'll always find someone. Whereas finding private money lenders, developing that relationship, and especially having a system is very hard. That is what I teach my students in my capital raising mastery system. If you're interested in that, the details are in the description. Meanwhile, please don't forget to grab the free PDF that I have, top 5 places to raise private money. You can download it, and I would love for you to subscribe to this channel, and I hope to see you in the next video soon. Thanks.